Join the growth accelerator with XYZ Banking and Financial Services Fund. NFO is now open and the scheme units are priced at 10 rupees. Ria received an email from a mutual fund company containing an advertisement for an NFO. The email stated the popularity of mutual funds is increasing. Along with that, the number of fund companies, that is AMCs, is also on the rise. Have you ever wondered how these mutual fund schemes come into existence? Well, the answer to that is NFOs, that is new fund offers. Is it necessary for Ria to invest in an NFO, or is she just drawn to it because units of the open-ended scheme are available at a price of 10 rupees? Has she assessed her ability to take risks when it comes to investing in NFOs? Well, for investors like Ria who are already investing in existing mutual funds, the situation can be confusing because so many NFOs are being launched. So then, should she invest in NFOs now or continue investing in existing mutual funds? Well, this could be a question for many people, and before seeing an answer, it is essential to understand what NFOs actually are. Essentially, when a mutual fund company launches a new scheme for the first time for subscriptions, it is called a new fund offer or an NFO. NFOs help mutual fund companies raise funds to purchase securities. Now, typically, the price of NFO units is fixed at 10 rupees per unit. Fund managers launch NFOs based on the current market trends. Any investor should first know that NFO comes in two types: open-ended and closed-ended funds. Under open-ended schemes, investors have the freedom to enter and exit the scheme at any time. In contrast, closed-ended funds have a limited number of units available for purchase, and after the NFO closes, investors cannot buy units. However, for investors in open-ended funds, subscriptions are reopened at the net asset value or the NAV on any working day. Investors who couldn't purchase units during the NFO can later buy units under the existing mutual fund scheme as well. Before investing in an NFO, it is essential to consider some of these factors. One of them include keeping track of past performance, information of which is always included in the offer document, although it is not mandatory. If you have already invested in a fund, pay attention to reviewing its performance every quarter for the first 3 years. To understand the trend of returns, you can compare the performance index of the mutual fund with its peers, that is, similar schemes. Investing in NFOs involves risks. In comparison to an existing mutual fund, there is no track record of past performance in an NFO. This makes it challenging for you to assess asset allocation and risk easily. Additionally, you may not know how the fund manager intends to utilize your money. Without any standard or indicator, assessing the success of a fund can be challenging. Therefore, investors should read the offer document very carefully. On the other hand, what sets the existing mutual fund apart from an NFO is its benchmark, consistent returns, and a track record of performance based on returns. Speaking on this, Vishal Jain, CEO of Zerodha Fund House, says that when comparing NFOs and existing mutual funds, one should keep in mind that new fund offers can provide unique opportunities. Since most of them are open-ended schemes, individuals can consider investing even later. On the other hand, existing mutual funds have a track record that provides complete information about their past performance. In conclusion, it can be said that investors should choose investment options based on their risk-taking ability and investment goals. Although there will be many opportunities to invest in NFOs in the coming months.